Our allocations within our multi-asset portfolio, one, are overweight to U.S. equities. Again, do think that's where we see the best kind of risk reward, if you will, currently. And then within that allocation, it's a mix of an allocation to NASDAQ. So yes, seeing the potential within the tech sector. But to be honest, that's fundamentally a view on the impact of AI. And I think it's quite interesting if you look at how earnings expectations have evolved over the last year. And you contrast, say, expectations for NASDAQ 100 index and the Russell Value Index. And I think it's an important distinction because when you look at the S&P 500, essentially you have a mix of the two, which means you can miss what's going on underneath the surface. But if you separate it into essentially growth and value, or NASDAQ and Russell Value, you see different trends. On the growth side, on the NASDAQ side, earnings expectations have been rising, and post the election last November, they more or less continued at the same rate. There was no discernible change, which to me suggests that what's driving those earnings expectations is AI. Now we can talk about whether those expectations are reasonable or not, but they're there, and that's what's driving, we think, primarily the price appreciation. On the other hand, if you look at expectations for Russell Value post the election, you do start to see an upturn. So they're clearly an impact in terms of investor, or at least analyst expectations. Our allocation then, number one, is to NASDAQ, based on that view on AI, but also to equal weighted S&P to pick up the change in the other parts of the market. The advantage of an equal weighted index for the S&P as opposed to the S&P itself really is that weighting for tech. And for us, if we're already allocated to NASDAQ this way, it allows us to increase exposure to the US without unduly increasing that allocation to tech. Well, again, it's important, to distinguish between the economy and the market. Of course, as investors, we're not buying GDP, and even though we've seen that Germany is still likely in a recession, or has been over the last year or so, equity markets have done reasonably well, frankly. So Germany's been a decently performing market. From that point of view, so not an economist and don't have forecasts on what's going to happen in terms of economic growth. But Germany, of course, their companies are very export dependent. So what happens within Germany, it's certainly significant, but it's what happens in the rest of Europe. Demand from the U.S., should also benefit European exporters, which is one of the reasons still fundamentally think earnings will rise, the markets will appreciate.
Despite the tariff threat?
Well, that's the point. It's at this point, it's still just a threat. So we don't know what the details are. The other point to make also is, we talked a lot about, say, core Europe, Germany, but other parts, versus the periphery. But of course, it is in the periphery now where you really do see the growth. I think the PMIs, the Purchasing Manager Indices for Spain, are around 57. It's one of the highest. So it may be, certainly we see what happens in the larger core countries, but it may be a story about what happens in some of the markets that we had avoided, or at least perhaps had neglected previously. A lot of investors now are starting to look either at EM or at Asia, China, and then EM Asia ex-China, or EM generally ex-China, which I think makes sense because the dynamics, understandably, are quite different. On the China front, on one hand, have mentioned rising earnings expectations. That's always positive, and without question, if you look at valuations, they're far lower than they've been historically, and potentially that's an opportunity. I think the reason we're neutral still at this point is because of essentially the geopolitical risk and tariffs, and we just don't know enough yet. But potentially that turns out to be an opportunity. It's not one that we've taken advantage of yet. Alongside that, then, if you look at the opportunity within the rest of Asia, what's notable, particularly if you look at earnings expectations for 2025. Some of the highest are in NASDAQ. Again, not such a surprise there, given all that we know that's going on with AI and the rest of the space. But the other market that also has pretty high earnings forecast for 2025 year on year is emerging markets, but that's primarily concentrated within the tech sector. So I think the opportunity within EM Asia, again, even though we're neutral, might well be, so to speak, an EM parallel of what you have with NASDAQ in the US, i.e. it's more in the tech space, parts of the market within EM Asia that are exposed to AI. That potentially is an area where you could see more appreciation.